Hey there, and welcome. Today, we're diving into a topic that, let's be honest, can be super confusing for a lot of business owners: profit. Specifically, we're going to crack the code on how you get from the profit number you see in your books to the one that you actually pay tax on. Let's jump right in.
So imagine this. You've put in the work all year long, your accounting software is showing a nice, healthy profit, you're feeling good. But hang on a second. Is that really the number that the tax department cares about? Well, the short answer is no, and figuring out why is exactly what we're going to do.
All right, so this is probably the most important thing to get your head around. When we talk about profit, we're not just talking about one number. There are actually two. There's the profit your books show you, and then there's the profit that the tax law says you have. And understanding the difference, that's step one to really getting a handle on your business finances.
Think of it like this. Over on one side, you've got your accounting profit. This is kind of like the story your business tells itself, using the normal rules of finance. But then on the other side, you have taxable profit. This is how the government sees your business, and they have their own special rule book. Our whole mission here is to translate your story into their language.
Now, before we get any deeper, just a quick note on some terms you'll hear. The law calls things like trade and manufacturing a business, and it calls things that need special training, like being a doctor or a lawyer, a profession. But here's the key takeaway for us. When it comes time to calculate that taxable profit, the rules treat them almost exactly the same.
So how do we actually start this whole translation process? Well, every big journey needs a starting point, a base camp, right? And for us, that's a number you're already very familiar with, your net profit.
Yep, that's right. The first step couldn't be simpler. We just grab that net profit figure straight from your profit and loss statement. This is our foundation. It's the starting block that we're going to build everything else on.
And this is where things get really interesting. Our first big move is what I like to call the uphill climb. Because believe it or not, we're actually going to make our profit number bigger by adding back certain expenses that the tax law looks at and just says, nope, sorry, that doesn't count.
So here's the deal. Just because you spend money and your accountant called it an expense, that doesn't automatically mean it lowers your taxable profit. We have to go through and find all these expenses that the law disallows and add their value right back to our profit.
And check out some of these common ones. That income tax you paid, gotta add it back. Paid a penalty for breaking a rule, add it back. Even something that feels like a huge business cost, like buying a new piece of machinery, often gets added back here. The tax law is just incredibly specific about what it considers a deductible day-to-day expense.
Okay, remember this number, 10,000. It's such a perfect example of how detailed these tax rules can get, and honestly, it's one that trips up a lot of people.
And here's why it matters. If you pay a supplier more than 10,000 rupees in cash in one day, that entire expense gets disallowed. You have to add it all back. Why? Because the government really wants a paper trail. They want to see transactions happening through the banking system. So if it's not a check or a bank transfer, you could lose the deduction.
Okay, so we did the tough part. We climbed the hill by adding back all those expenses. But now we get a little bit of relief. It's time for the downhill path, where we actually get to subtract some things from our profit figure, bringing that number back down again. See, your profit and loss statement probably lumps together income from all over the place. But the tax law is kind of a neat freak. It likes to have everything in its own separate box. So our next step is to pull out any income that really belongs in a different tax category. For instance, did your business get some dividend income? Well, that gets taxed under income from other sources, so we subtract it from our business profit. Did you sell a piece of property and make a gain? That's a capital gain, so out it comes. What we're doing is carefully isolating only the profit that came purely and directly from your business operations.
We've done the adding. We've done the subtracting. After all these twists and turns, we have finally reached the top of the mountain, the summit. We are just about to land on the single most important number for your business's tax return. And there it is. That's the official name for it: profits and gains from business or profession. This isn't just a number from your accounting software anymore. This is the legally defined taxable income from what you do. This is the number that matters.
So why do we go through all this trouble? It's really about two things. One, it's about compliance, following the law. But honestly, the more important thing is that it's about empowerment. When you actually understand how this number is built, you can start making much smarter financial decisions for your business.
And making smart choices is everything, because sometimes the rules themselves change based on the tax system you pick. Just look at this example. A donation to a scientific research group. Under the normal, default tax regime, you can't deduct it. But if you choose the optional regime, you can. Knowing how the calculation works helps you decide what strategy is best for you.
So there you have it. We've mapped out the entire journey, all the way from your simple accounting profit to your final taxable profit. You've seen the additions, the subtractions, you now know the how. So the last question, really, is for you. Now that you know how the code works, are you sure you're making the best choices for your business?